Hi, this is Michael Yardney and welcome to my regular property market update. Despite many forecasters predicting a property crash over the last year, the major property markets around Australia, other than Perth, seem to have had a soft landing, haven't they? In fact, the lower end of the markets could almost be classed as booming, and property values have risen strongly in the first half of this year. It all started, of course, with the first homeowners, but now established home buyers are back borrowing money. Lending for owner-occupied housing was up by 2.3% in March, and the lending for investment purposes rose by 2.4%. This is the third monthly rise in lending to investors and leaves investment lending 19% above the February levels. Investors are now clearly back in the market, and all of a sudden the same media that was predicting a property crash is talking about the next property boom. But hold your horses. Don't get too excited. There's still a rocky road ahead of us. Look, when I heard this morning that Henry, my barber, has bought himself an off-the-plan property in what he was sure was the next hotspot, I knew some investors were getting a little bit too excited too soon. Now, don't get me wrong. I'm not saying it's not a good time to buy. It is. But you can't just buy anything. We may be on the road to recovery, but it's going to be a rocky road. So has the market bottomed? Well, let's first talk about the economy. While the global economy is going through its worst recession in over 70 years, the Australian economy has held up remarkably well. We've had a very mild economic downturn compared to other countries, and, if we use the true technical definition of a recession, we've so far avoided one. And now there are enough significant indicators that many of the world's economies have seen the worst, and in fact many are starting to recover, while others, well, at least they're not worsening anymore, are they? Now, having said that, it's likely that the Australian economy went backwards a bit in the June quarter, and that this will continue in the current quarter. This, along with falling inflation and rising unemployment, is likely to prompt a few more interest rate cuts over the next 6 months. However, later this year or early next year, a sustained economic recovery is likely to kick in, driven by a rebound in China, by our housing markets, and by public investment. In the meantime, economic indicators are likely to be a mixed bag. We're now in the stage of the economic cycle where mixed signals are going to paint a confusing picture for some of us. Some indicators are going to be signalling weakness, such as a rise in unemployment, and others are going to be pointing to an eventual economic recovery, maybe later on this year. So what does this mean for our property markets? Well, firstly, I'd like to remind you that we have multiple property markets. Each state has its own market, and within each state there are different sub-markets at different price points and in different geographic locations. Some are doing well, and others are still suffering. So it's a little too early for my barber Henry to go off and buy in the next hotspot based on his research on what the project marketers have told him. Over the last few months, I've spent a large amount of time poring over all the research material I could find regarding the property markets in Australia, and then looking back at my experiences over the last 4 and a bit property cycles to see if I could draw any comparisons. What I concluded was that in the long term, most property investors will do very well. But over the next few years, while some investors will make money from property using the correct strategies and buying the right property in the right place for the right price, the majority of investors will not fare well. When looking back at the performance over the last 10 to 15 years of a large portfolio of properties owned by clients and the performance of my own portfolio over the last 30 years or so, I realised that some properties performed much, much better than others, and I discovered what that secret ingredient was that made these properties perform so much better. Actually, I didn't really discover it. I guess I knew it all along. I knew what made some properties perform better, and it was an integral part of my investment strategy. I think what happened was that doing my research brought it back to me very clearly. You see, every decade or so, we see critical factors align to create a fantastic environment for building wealth. This is the beginning of a new cycle, a new opportunity for you to build your wealth. What we are seeing now has many of the hallmarks of one of the great wealth building opportunities that come around every so often. These are the times when fortunes are made, for those who are prepared and for those who are in the game. These are also the times when those who are not in the know will make the same errors that others have made in the past that'll hold them back. Now that's why I've got together with property tax specialists Ed Chan and Ken Race from Chan & Naylor to conduct my Roadmap to Recovery seminars in 4 capital cities next month. Please click on the link below and read all about these seminars and the over $200 worth of bonuses we have for those of you who attend, and then please reserve your place. Okay, so getting back to what's happening to our property markets. I've been investing in property for over 30 years, and I've realised there will always be someone or some publication explaining why I shouldn't invest in property. And at times these arguments seem to make sense, but history has proved them wrong. The average price of the home in the major capitals of Australia has just kept going up. Who wouldn't want to buy the property that their parents bought, their parents' home, at the price their parents paid for it? Yet there always seem to be good reasons to put off investing in properties over all those years I've been investing. However, property values just kept increasing consistently at about, 8 to 10% per year during that time. The same suburban house that my family bought in the 70s for $24,000 is now worth over $950,000. The first investment property that I bought in the 70s for less than $20,000 is now worth well over $800,000. So back to my question, have the property markets bottomed? My honest response is, I'm not sure. But I can't really see any reason for our property prices to fall further significantly. And my question to you is, are we really buying the market anyway? Clearly the answer is no. So what I recommend that you could do is consider investing in a property that you'd be happy to hold in the long term in your portfolio, which is bought sufficiently below its intrinsic value, so that even if the markets do fall a bit further, you would have still bought well. Now, in uncertain times like we're currently experiencing, no one can help you quite like the independent property investment strategists at Metropole. By the way, we help homeowners too, not just property investors. And remember, we've got no properties to sell, but we've got access to every property on the market. So if you want to find out a bit more about what's happening in your local markets and what our research suggests is in store, join us at one of our free property briefings in Melbourne, Sydney or Brisbane. Just click on the link lower down to reserve your place. Now obviously my full day seminar with Ed Chan and Ken Race will be much more comprehensive than these boardroom briefings that only last an hour or an hour and a half. But they're a great place for you to start and they're free, so please click on the link below and join us at one of those briefings. Now, as I started to explain, using my barber Henry as a prime example, the rules are very different today than they were a few years ago. You just can't buy any property and hope it'll increase in value. You've got to buy in the right location. Yes, that old rule of location was forgotten by many investors over the last few years. And now, many of these are paying the price for making unconsidered and often emotional buying decisions. There are currently many secondary properties on the market, ones that wouldn't pass our investment criteria, yet they're being snapped up by buyers in a hurry to get into the market. Avoid these properties and instead look for properties in top locations, bought considerably below intrinsic value, and particularly properties to which you can add value so that you can manufacture some capital growth through renovations or property developments. The real estate markets are constantly changing, and they always will. Embrace change and you'll be prepared to profit from it. Those who ignore change will often become its victims. So are you ready to exploit the opportunities that will arise? If so, please join us at the Roadmap to Recovery full-day seminars. Click on the link below. Fortunes were made last time at this stage of the property cycle. But interestingly, at the same time, many inexperienced investors missed out by buying the wrong properties. I look forward to seeing you at these seminars and keep educating you through property updates.